Chapter 12 talks a lot about the returns to the stock market. And we've actually had some very interesting times here recently. In fact, I have to say that I think probably the most important thing you will learn in this entire semester and all your classes is some perspective on the stock market. Because we've seen such a dramatic decline in the market over such a short period of time, I think in the future you'll be able to look back on this and remember what happened. And what's going to happen from here on out is the price of the market's going to go back up. And you can count on it. I'm not sure exactly when, but it will go back up. And what I hope you learn from all that is don't panic and sell when the market's at the bottom. Instead, realize in the long term it's going to be up. As for myself, I think I've shared with you that I've lost a big chunk of money during those past few weeks. And then just the other day I decided, okay, I'm going to go ahead and put some more money in the market because it's down so low. And sure enough, that money has gone up in value. So in the long run, if you just keep putting money in and what's called dollar cost averaging, just keep putting money in regardless of whether the market is doing well or doing poorly. Because when the market is down, your same contribution, your same investment actually allows you to buy more shares because of the lower price. And if you're in it for the long haul, you'll end up with a lot more money if you just stick with the program. Okay, enough for that advice. What I want to do now is show you some information about the Dow Jones Industrial Average versus the Standard & Poor's 500. So here is a list of all the companies in the Dow Jones Industrial Average, or often called the Dow Jones 30. This is as of today, as I'm recording this, is March 25th, and this was actually during the day that that the Dow Jones Industrial Average was at this level, and with a huge increase. The increase yesterday was very dramatic, and so just on my new investment, the new portion of my investment, I did really, really well in one day, but I still have a long way to go for the rest of my investment to catch up. But I wanted you to see the companies that are in the Dow Jones Industrial Average. 3M. If you're not familiar with 3M, if you've ever used Scotch tape, you've used a product by 3M, or Post-it notes. American Express, Apple, Boeing, Caterpillar, Chevron, Cisco, Coca-Cola, Disney, Dow Chemical, Exxon Mobil. You get the idea. These are all big companies, and you've heard of probably 9 out of 10 of these companies. And the other ones you've heard, you probably will hear of in the not-too-distant future. So these are huge companies. Now let's look at some of the companies that are in the S&P 500. Okay, so I have just a few of them. Remember, they're 500, but I've just shown that here's 3M, and remember 3M was one of the Dow Jones Industrial Average stocks, or they'll just say the Dow Jones stocks. American Express was the second one listed, and Apple was the third one listed, and you get the idea. So there are a whole lot of companies, namely 470, that are in the S&P 500 that aren't in the Dow Jones Industrial Average. One thing you might want to be aware of is that these are not listed in order by the symbols. As you see, it starts with MMM, but 3M is the company name, so it's all in alphabetical order according to company name. And I've always enjoyed this one. AT&T is just the symbol T for telephone, and it's had that for forever. Now what I'd like to do is to explain why it is that I prefer the S&P 500 over the Dow Jones Industrial Average. And this may seem a little bit arcane, but I do think it's important. I've never understood why people put so much stock, so to speak, in the Dow Jones Industrial Average. I think it's a terrible index. And for these reasons, it only includes 30 stocks. they are all gigantic stocks. So it's not so much representative of the whole market as it is a representative of the large company stocks. It's not representative of all sectors. For example, there are no transportation companies. For example, there's no airline in the Dow Jones Industrial Average. And it's poorly constructed because it's price weighted. And what I'd like to do now is show you why that is an issue. So the Dow Jones Industrial Average is price weighted. And here's the formula for the Dow Jones Industrial Average. This says take the sum from stock 1 to stock 30, because there are 30 stocks, take the sum of their prices, and then divide by the divisor. And that probably seems reasonable enough until you wonder what's the divisor. Well, when the stock market index was created, there were 30 stocks, and they divided by 30. So add them up, divide by 30, and you get the average. Well, things change over time. And one of the things that changes over time is the fact that stocks split and have stock dividends. And so let's talk a little bit about the effect of a stock split and a stock dividend. So what is a stock split? A stock split occurs when the company feels that their trading range of their stock is too high. So, for example, let's imagine these are stock splits. Let's say that the stock is selling for $300 per share, and let's say there are 1,000 shares, and that's a total market value of $300,000. And let's say then that they feel that this stock price is such that for somebody to buy a round lot, which is 100 shares of this stock, it costs a lot of money, and so that might keep some people from being in the market to buy their shares. So what they might do is say, let's have a stock split. And in this case, they might decide, $50 is a nice range, so let's issue enough shares so that the stock price will fall to this reasonable range of around 50. So maybe they decide to have a 6-for-1 stock split. If they have a 6-for-1 stock split, everyone who has a share is going to have 6 shares instead. And so the number of shares will be 6,000. But there's no reason that that company should be worth any more money, because there's no additional funds going into the company. Why should there's no reason that they should be able to make more earnings just because there are more shares outstanding if no money came into the company. So it should still equal 300,000 of market value. Well, what we have here is this is multiplied by 6. And so what has to happen here, this has to be divided by 6, and it will drop down to 50. And then you have 50 times 6,000 is 300,000. So that's what happens with a stock split. And let's look at a stock dividend. Now, when you hear the phrase stock dividend, you probably think of what's really a cash dividend. So a company makes money, it decides to pay a dividend, it sends out checks or credits your bank account for the amount of the dividend, the end. Well, a stock dividend is really very much like a stock split. And this happens especially for fast-growing companies that think that psychologically their shareholders will be happy if they get a stock dividend, even if it doesn't do anything terribly positive for them. So let's imagine that you have $100 stock price, and you have 1,000 shares. So it's worth $100,000. And let's say you give a 10% stock dividend. So 10% stock dividend would be you would have 1,100 shares. But again, there's no reason for the company to be worth any more than what it was worth before, which is $100,000. So the stock price would have to drop to $90 and approximately $90.91. $90.91 times 1100 is equal to our $100,000. So there are more shares and the price falls. Now let's go back to our formula. If you issue more shares and the price falls just because of the stock dividend or stock split, the numerator will go down, and unless you adjust the divisor accordingly, the index will go down, and it'll seem like the market has done poorly when actually all that happened was that there was a little accounting adjustment. So they adjust the divisor just enough so that no effect is caused by that stock split or stock dividend. They assume all the other stocks stay constant in price, make the adjustment for the one stock split, adjust the divisor, and from then they do change all the stock prices from then on. But that's how they adjust the divisor. Now you might wonder, well, gee, what's the divisor now? Well, this is a page that I've reproduced from today's Wall Street Journal, March 25th. And you see, this is very ugly. Prices are going along here, and then COVID-19 hits, and boom, down we go like this. So yesterday was good. Today it looks like, I think it's continued to be good. I don't have the exact value, but at least it was doing well for a time today. But what I wanted to show you was every day in the Wall Street Journal on this page that shows the Dow Jones Industrial Average, it lists the current divisor. And the current divisor is 0.147445683533097. So if you wonder sometimes, well, why do we have to go to so many places? Why do they go to so many places? So that is how the Dow Jones Industrial Average is calculated. Now here, and it's a price-weighted version, and the higher the price, the bigger your importance in this numerator. So a high stock price is a bigger part of the numerator than a low stock price, and we'll see sort of how that works to the disadvantage, I think, of investors and trying to figure out what's going on in the market. S&P 500 is market value weighted, so it actually considers what happens to the total market value of the stocks in the index. And here it is the numerator is price times quantity for every stock. So stock I equals 1 to 500. I is just an index associated with the particular stock. So take every stock, and let's just say stock 1, and time t, which is, let's just say right now, and time t, we've got price times quantity for stock 1, price times quantity for stock 2, for stock 3, 4, 5, through 500. Add them all up, and that's your numerator. In the denominator, we do the same sort of thing for the base period. And I accidentally had a T here. This is a B. So I've got the price for every stock times its quantity, but in the base period. So this stays the same. And this then in the numerator, we've got total market value currently of all the stocks. And in this denominator, we have total market value of all stocks during the base year. So numerator is the current market value of everything. Denominator is the base market value of everything. And then we multiply times the base year index value. For the Standard & Poor's 500, the index, I believe, is started in 1951, and I believe the starting value was 10. So you would continue using this number and this number, 10 and whatever this was, and all you do is change the numerator. Now to get a little bit more complex, they do change out stocks now and again for the S&P 500, and as they do for the Dow Jones, and they do have to make adjustments sort of to change the history to reflect the fact that that a stock that was in there is no longer in there. So what I wanted to show here is how these two different indexes would handle a particular change. So we've got two stocks, A and B, and they're in both of these indexes, a market value weighted and a price weighted. And let's assume nothing else happens to any of the other stocks. All that happens is a change to A and a change to B. And I've got the wrong number here too. That's a 4. So let's say that stock A had a stock price of 100 and it had a number of shares of 20,000, and so that gives it a market value of 2 million. And let's say stock B had a price of 20 with 200,000 shares for a market value of 4 million. So the sum of their prices, and that sort of has to do with this, the sum of their prices was 120. The sum of their market values, which is up here, was 6 million. Now let's assume that stock A goes up by 5%. It would go up by $5. 5% of 100, $5. And let's say that stock B goes down by 5%. Minus 5%, minus $1. Now let's see what would happen. New price total would be 105. This 100 goes up by $5. That's 105. And stock B would go down to 19. 20 minus 1 is 19. So the new sum of the prices would be 124. Now the new market values would be 105 times 2 million is 2,100,000, and 19 times 4 million is 3,800,000. So the new market value is now 5,900,000 and not 6 million. It has gone down. So the effect of this is that these changes for these two stocks, one goes up by 5% and the other goes down by 5%. In our little index here, the price-weighted version shows an increase in the numerator, and we won't bother with the denominator because the denominator will not be affected, an increase in the numerator of 4. That's a 120 up to 124. For the S&P 500 version, that is the value-weighted version, the market value went down by 100,000. So that index would show a decrease in value. So now we have the same event, the same pair of events, has one index going up and the other index going down. Now my argument would be that it's market value that matters, and if the market value of everything went down, then the market went down, not whether a stock price happened to go up. So that's my concept of why I prefer the S&P 500 over the Dow Jones Industrial Average.